All right, so in the last video we talked about under the allowance method, you estimate your bad debt expense at the end of the period because we need to record bad debt expense in the same period as the sales revenue due to the matching principle. So we know we're going to make an adjusting entry to debit bad debt expense and credit allowance for bad debts. Now we're going to look at how do we estimate the amount of that journal entry. And we have three different methods for doing that: percent of sales, percent of receivables, and the aging of receivables. So the first one we're going to look at is the estimate based on the percent of sales. So let's think about the entry to record a credit sale. So when we make a sale to a customer on account, we debit accounts receivable, we credit sales revenue. The estimate based on percentage of sales focuses on the sales revenue part of this entry and says how much of the sales revenue won't be collected. And that amount of sales revenue that won't be collected is going to be our bad debts expense. So the way we do this is management will do an analysis. So someone will go and look back at our past history to see in previous periods how much of our sales revenue was not collected because customers just didn't pay their accounts. And so you'll work up the amount from previous periods, average it, and maybe adjust that average up or down based on what's going on in the economy. So for example, after the COVID-19 crisis, a lot of businesses were shut down. They weren't taking in cash, probably weren't paying their bills. So you would expect a larger amount of customers not to be paying their bills. So a lot of work would be done to come up with this estimated percentage. We are not going to be doing the work in this class. We are going to be given that percentage. And we'll take that percentage, multiply it by the net credit sales or the net sales revenue. That's going to give us our bad debt expense. So our adjusting entry is to debit bad debt expense, credit allowance for bad debts, and that will be for the amount that we calculated. So let's take a look at an example. We've got sales revenue of $300,000. Allowance for bad debts has an unadjusted credit balance of $700. Analysis shows that 1.2% of our sales revenue is uncollectible. So we know we need to debit bad debts expense and credit allowance for bad debts, and using the percent of sales method, we're going to get the amount of this entry. So we're going to take the 1.2%, multiply it by the 300,000, that gives us 3,600. That's going to be the amount of our adjusting entry. Of the three methods, this is the one method that does not have a target balance for allowance for bad debts. We are not worried about what this allowance for bad debts unadjusted balance is. Okay. When this 3,600 credit gets posted to the 700 credit balance that it already has, now it's going to have a 4,300 credit balance. And that's just the way it is. Our focus was on getting the amount of this journal entry, and that's going to be different than what we do in the other two methods. The other two methods are the estimate based on accounts receivable. So we're focusing on the accounts receivable side of this journal entry to record a credit sale. We're saying how much of the accounts receivable won't be collected. And the amount of the accounts receivable that won't be collected is going to be the target balance in the allowance for bad debts. That's the amount we want to show as our allowance for bad debts. Right? Because we said accounts receivable is the amount all of our customers owe us. Allowance for bad debts is the amount that we don't think we're going to collect. And that's what we're calculating here, is the amount of accounts receivable that won't be collected. So the way we do that is, again, we've got two methods of doing this. So under the estimate based on receivables, we've got the estimate based on percent of receivables. So kind of similar to the estimate based on percent of sales, we're going to look at past history to see what percentage of accounts receivables weren't collected in past accounting periods. And again, we'll average it, adjust it up or down, right? For our purposes, this estimated percentage is going to be given to us. And we'll take that percentage, multiply it by the amount of our accounts receivable, and that's going to give us the target balance in the allowance for bad debts. So that's the amount that we want to have as an ending balance in the allowance for bad debts, and we have to make our adjusting entry to get us to that target balance. So we're going to debit bad debt expense, credit allowance for bad debts, and if there was an unadjusted credit balance, we're going to subtract that from the target balance. That will give us the amount of the entry. If there was an unadjusted debit balance, we're going to add that to the target balance. That'll give us the amount of the entry. I don't like to look at these in formulas. I get as formulas because it's easy to forget. Do I subtract? Do I add? I like to look at the T account. Okay. So our allowance for bad debts, we started the period with the beginning balance, right? What we thought was going to be uncollectible. And then in the next period, we found out specific accounts that weren't going to be collected. And so we wrote them off. And we would have debited allowance for bad debts because we credited accounts receivable. And so if we estimated perfectly and we wrote off exactly what we had estimated what our beginning balance was, our unadjusted balance would be 0 at the end of the period. Okay? But we know we don't estimate perfectly. So let's say we had a beginning balance of 100, okay, because we thought that was what was going to be not collected. Well, it turns out we only wrote off 90. So that's how we can end up with a 10, in this case, unadjusted balance. It's a credit unadjusted balance. But we could also end up with an unadjusted balance that's a debit. So in this example, we started with 100 beginning balance, but then we actually wrote off more than we expected. We wrote off 105. So that's why we ended up with a 5 debit balance. So the unadjusted balance at the end of the period can be either debit or credit. We know allowance for bad debts should have a credit balance. So after we make our adjusting entry, the balance for allowance for bad debts will end up on the credit side. So let's take a look at an example. Accounts receivable has a balance of $10,000. Allowance for bad debt has an unadjusted balance of $50 credit. We've done our analysis. We estimate that 7% of accounts receivable is uncollectible. So we're going to make our adjusting entry to debit bad debt expense, credit allowance for bad debts. And the way we get the amount of the entry is we first take the accounts receivable balance, multiply it by the estimated percentage. So 700 is the amount of accounts receivable we don't think we're going to collect. That is what the target balance is in the allowance for bad debts. That's the amount we want to have as a balance in allowance for bad debts. Well, we can see we're told allowance for bad debts has a $50 credit balance. So I like to draw a T account. Okay, we've got a $50 unadjusted balance. We want it to have a 700 balance. That's our target balance. And the target balance should always be credit. That's the normal balance in allowance for bad debts. So we have to make an adjusting entry to bring the allowance for bad debts from the 50 unadjusted balance to the 700 target balance. So how are we going to get from 50 to 700? So to go from 50 to get it to 700, we need a credit of 650. So we are going to make our journal entry for 650. Debit bad debt expense 650, credit allowance for bad debt 650. So the 650 is going to be reported on the income statement, right? This bad debt expense will be shown under operating expenses on our income statement. When we post the credit of 650 to the allowance for bad debts, that makes allowance for bad debts to have an adjusted balance of 700. That's what we wanted it to have based on our analysis. So this is the amount that's going to be subtracted from accounts receivable on the balance sheet to get to our net realizable accounts receivable. We have our third method, right? And this is another estimate based on accounts receivable. So this third method is an estimate based on aging of accounts receivable. So this is kind of a similar idea to what we did with the last method, but it's going to be more involved. It's going to be more accurate. So what we're going to do is we're going to prepare an aging schedule. So we're going to look at all of our account balances and we're going to see when they were due. So we'll put them into categories. So these are examples of categories. Companies can use different categories, but not yet due, 1 to 30 days past due, 31, 61, right? Because the idea is the longer an account is overdue, the more likely it is that you're not going to collect. Okay. So we'll take the account balances, compare the due date to today, the last day of the accounting period. If it was due before, if it's due after the end of the period, it's not yet due. Okay. If it was due before the end of the period, then we have to determine how long overdue it is. Okay. So then we're going to assign a percentage of what we estimate from each category that will not be collected. Okay. And we can see the longer it's overdue, the higher the percentage is, the more likely it is the customer isn't going to pay us. Okay. And then we'll multiply the percentages by the total from the categories, and we'll come up with what we estimate isn't collectible for that category. If we add together all the amounts that aren't going to be collected, we'll get the total amount of accounts receivable that won't be collected. This amount is going to be the target balance in the allowance for bad debts. So again, we have to make a journal entry. Debit bad debt expense, credit allowance for bad debts to get us to that target balance. And I would prefer to draw the T accounts as opposed to looking at these formulas. Okay. After we post the journal entry to record bad debt expense, the balance and allowance for bad debts will be the amount from the aging schedule because that was our target balance. So here's an example. We've got $9,000 in accounts receivable. When we put it into categories, 5,000 of our customers' accounts are due after the end of the period. Of the 4,000 that are due that were already due and the customer didn't pay us before, they were supposed to pay us before the end of the period, 3,000 are 1 to 60 days past due, 1,000's over 60 days past due. And we have estimated the percent from each of the categories that will not be collected. So we multiply the total amount for the category by the estimated percentage. And then when we add up the amount that's uncollectible for each category, we can see that we estimate that 800 of our accounts receivable won't be collected. 800 is the target balance in the allowance for bad debts. That's what we want to be showing as a balance. That is what our adjusted balance should end up being for allowance for bad debts. Our unadjusted balance in allowance for bad debts is 20 debit. Okay. So that's why I like to draw the T account. We want it to have an 800 credit. We have to make an adjusting entry that will bring allowance for bad debts to the 800 credit. And we know to find the balance in the account, we take the total from the two sides and subtract, and we put it on the side that's higher. So to get an 800 credit balance, we need an amount on the credit side of the T that's 800 higher than this debit balance. So we have to make our adjusting entry for 820. So we debit bad debt expense 820, credit allowance for bad debts 820. So the bad debt expense of 820 is going to be reported on the income statement. And then when we post the 820 to the allowance for bad debts, that's how we get to the 800 adjusted balance in allowance for bad debts, and that's what we wanted to happen. So this is the journal entry we would make if we were using the aging method to estimate our bad debts expense.